Hello, everyone, and welcome to Practical Applications for First Nations Finance. This is our second session in the series, and it is about bookkeeping systems. So what is bookkeeping? Bookkeeping is maintaining financial records by entering and sorting transactions such as payments, deposits, bills, and charges in our accounting software. So examples of accounting software are Sage 50, Sage 300, QuickBooks, Adagio, and there are many others. Nowadays, we're very lucky we have accounting software. Our accounting ancestors a long time ago used to do all that work manually. So they would have to record all the transactions manually and then manually prepare financial reports. And this is why I think bookkeeping has reputation of being tedious and boring. But nowadays, it doesn't have to be that way because we have all the wonderful accounting software that hopefully makes it nice and easy. So source of information for bookkeeping, well, we have our bank and credit card statements that have the majority of charges for our organization. Vendor bills, check requisitions, receipts, deposit slips, basically any document that supports the transaction, okay? Now, some of these documents are generated externally. So we can receive a bill from a vendor, right? That's externally generated. Or we can receive a deposit notification from Indigenous Services Canada or other funder. And some of that actually is generated internally. So we issue an invoice to a customer that's generated in our accounting system. And, by issuing that invoice, we're already recording it in our bookkeeping system, but also providing the invoice to the customer. So it's a combination of running our business operations and recording the transactions in our bookkeeping system. So accounting software makes it very, very efficient. Again, we're very, very lucky, unlike our ancestors, that we can use software. So bookkeeping is normally done using the accrual basis of accounting. We spoke about it in our first lesson. Now, really what that means is in an accrual basis, we keep track of amounts owing from customers and amounts owing to vendors. So it doesn't matter if we haven't paid a vendor bill yet. If we already received the service and received the bill, we record it in our system and showing an amount owing to the vendor. Okay, so amounts owing from customers are called accounts receivable or AR, and accounts owing to vendors are called accounts payable or AP. Now, our bookkeeping systems have subsystems. So there is a subsystem for revenue and accounts receivable or AR, another one for expenses and accounts payable or AP, and then the third one is for payroll. Now, this is just good to know for our future lessons because we'll go in detail through different subsystems and reporting in them. So let's talk about the bookkeeping process. It may be new for some of you, or it may be very, you may be experienced, so it's very clear. So just view this as a review. So the bookkeeping process starts with a source document. So we have a check requisition, a vendor bill, a customer invoice. That is what's going to get entered into our software. So we review the document, and a part of our bookkeeping is actually a conscious review of the document we have in front of us, right? So we review the document kind of critically and we say, okay, is this document for our organization? Does this make sense? Do we have questions about it? Do we need to contact a program manager to ask? When do we need to pay it? So it gives us an opportunity to kind of manage our organization's finances, and at the same time enter the information into the software. So we review the document, and then we enter the details into the software, and at the same time we're telling the software how to sort it or allocate it. So our first allocation is to a category. So say if it's an expense, if we bought some office supplies, we'll tell the software posted to office supplies. And then our next allocation is to a program. So if we run many different programs, which is true for any non-for-profit organization or a First Nation, because we get funding from different funders or for different streams or different programs, then we would need to tell our software, allocate this to this program. So if I bought business cards for chief and counsel, and I'm going to call it office expense and say it belongs to band support, when I enter it into my software, I will have to tell the software, okay, this is office expense and this is band support program. Okay, so income and expense categories such as office expense or wages are called accounts. That's just a term we use in bookkeeping. So the accounts are set up based on the needs of our programs, what we need to spend on, and also based on funder requirements. So many times funders would give us budgets, and budgets would show categories that are eligible expenses for our program. And so we want our accounts to match those categories that the funder gave us, just because we will use our financial reports to report back to the funder. And the funder would like to see the reports aligned to their budget. And so our accounts or categories should match what the funder requires ideally. Then we have departments or classes, and they're both terms used in different accounting software for different programs. So those would be set up for individual programs, so we can produce reports by program. So in my example, I would have a separate department or class for band support. So when I post those business card expenses to chief and counsel, I allocate to band support, and when I print my report for that program, it would just show what was allocated to that program. So this is all entering transactions into our software. And again, it's important to remember that some of the transactions are entered as a part of running our organization. So if we are printing a check for someone, if we're paying someone, normally we do it from our bookkeeping software. So we're doing two things in one action. We're issuing a check to a vendor and recording it in our software. So this is perfect, right? This is better than having to go back and try to enter things that happened outside of our bookkeeping software. So ideally, we want to get to a point where our operations and our bookkeeping are intertwined. So every transaction is made in our accounting software and is recorded as it's made, such as wages or vendor payments, customer invoices, and so on. So then we've entered all these transactions. However, we would like to verify that our bookkeeping is correct, that all our balances are right. And so there are certain things that we do at month end, sometimes at quarter end, but realistically, the more often we do it, the more accurate our records are. So month end is a more recommended procedure. So we do things like reviewing our reports, reviewing our financial reports by programs, reviewing our expenses and revenue, just to make sure everything in there makes sense, okay? And we also do what's called reconciliation. So reconciliation is a fancy accounting word that really just means we're matching transactions in our bank accounts in bookkeeping 2 transactions on the bank statement. So what we're doing effectively, we're saying majority of transactions in our organizations go through either bank statements or credit card statements. So bank statements or credit card statements are external documents we can use for verification. So if a payment went through the bank, then we know for sure it happened. So when we match records in our bookkeeping software to the bank statements, and we actually do transaction by transaction to make sure everything matches, we verify that our accounts and records are correct. In general, until your reconciliations are done, your records are very likely incorrect, or at least not fully correct, because there's always things that go through your bank statements or credit card statements that don't necessarily get picked up during your regular operating activities, okay? There can be bank charges, there can be certain checks that got cashed from a long time ago that you won't see unless you go through your bank or credit card, okay? So then after we've done our review and reconciliations, we print the financial statements and submit them to management and funders. So we talked about the importance of source documents in bookkeeping. Every transaction in bookkeeping needs to be supported by a certain document. Let's go through those source documents for the different subsystems we talked about. So we'll go through revenue, expenses, and payroll. So bookkeeping source documents for revenue include deposits reports from funders, customer invoices and receipts we issue, deposit notifications, bank deposit books. There may be other source documents that you come across when you actually do the bookkeeping. Those are the main ones we're listing. We'd like to talk about customer invoice versus receipt, because sometimes there is a confusion when one is used versus the other. So customer invoice is used when there is a two-step transactions. First, we issue an invoice to the customer, and then they pay at a later date. So payment and issuing an invoice and making a sale are on different dates. They're two separate transactions. Customer receipts is issued when there is no timing difference between making a sale and receiving a payment from a customer. If they pay right away, we just give them a receipt. So why is this important in the bookkeeping system? Whenever we issue an invoice, it would show an amount owing from customer, that account receivable, right? And that account receivable is going to be sitting in our system until we receive that payment and apply it to the account receivable. So we'll use customer invoice when we actually need to keep track of that account receivable. Now, if a customer paid right away, we can just issue a receipt, and then we don't have to worry about having an account receivable and applying a payment to it. Okay, now in some software, the only option you have is customer invoice. So if a payment happens right away, we'll issue an invoice and then apply the payment right away. But we thought it's important to define those two, because in some software, there are two different things. We normally don't issue invoices for government funding unless requested. We have funding agreements with Indigenous Services Canada and CNIB, and funding comes on a monthly basis based on those funding agreements, so no invoices are necessary. However, sometimes we have a one-off project with, say, a different nonprofit organization, and even though there is a funding agreement and they know when to flow revenue, for their system, they prefer getting an invoice, so they would reach out to us and say, can you issue me an invoice for this payment, for this funding? And then we do it, okay? So now let's go through examples for source documents for revenue. For some of you, this is, you know it very well. For some of you, this is new. So we'll do a quick overview. Okay, so my first example is customer invoice issued from our bookkeeping software. Okay, so this is an example of when our operations and bookkeeping happen at the same time. You'll see I don't have a logo here just for confidentiality purposes, but normally you'd have a logo, address, and something looking very nice and formal, saying, okay, here's the invoice. There is an invoice number, important, normally assigned by our bookkeeping software. There is the date of the invoice when we issue it, and then there is a due date when the payment is due, right? And it indicates the terms. This is who the invoice is sent to, so the customer. And then you'll see in this particular case, the First Nation is invoicing for its equipment being used in the construction project. Sorry. So, so there is some equipment hours here being billed to a customer, a construction company. Next example is a bank deposit slip. So when we receive checks from funders and customers, we would normally use a bank deposit slip to deposit the checks into our account. So you'll see here we have a list of checks received. So there is $1,000 received from the tribal council and so on and so forth. And then at the bottom, we have the total of our deposit and the number of checks deposited. So we would take it to the bank would deposit the checks and put a stamp on our deposit record. And then this deposit slip will be used to support recording a deposit in our bookkeeping system. Next one for revenue is an expenditure report. It's called Expenditures by Recipient Report from ISC, Indigenous Services Canada. So they send those monthly to show what deposits went into our account, what programs they belong to. So in this particular case, this First Nation received capacity building funding of $22,500. So this is going to be used as support for our bookkeeping. Some software allows us to attach it electronically. If not, then we'll keep it as paper support to show why we recorded $22,500 in ISC revenue for a capacity building program. Okay, let's go back to our presentation. Let's talk about bookkeeping source documents for expenses. So we have vendor bills or invoices, we have check requisitions, we have electronic fund transfer reports, check stubs, credit card statements, and receipts. So again, there may be other documents that are relevant, and for the person that's managing the program or doing the bookkeeping, whatever that person feels is relevant to support the transaction, that's our supporting documents. Because we may be audited by the government, by whoever gives us funding, and we want to make sure that every expense has its support. Also, for financial statements audit at the end of the year, we do need those supporting documents because the auditors will request them. So in a well-managed program, we use check requisitions for all expenses. This is because check requisitions have signatures for approval, right? So then it's very clear who initiated, who approved, the date, the amount, everything. Let's talk about vendor bill versus expense. So just like customer invoice and receipt, this is two-step transaction versus a one-step transaction. So for vendor bill, we receive an invoice from our vendor, but we don't pay it until later. So there's two transactions. This is when we made a purchase is one transaction, and then when we actually pay the bill is the next transaction. So when we make the purchase, we still record it in our accounting software, just because this is an expense that happened, even though we haven't made the payment yet, and we owe that money to the vendor. When we record a bill or an invoice, we'll show a corresponding amount owing to the vendor. And when we make a payment, that payment will apply to reduce the amount owing to the vendor. So in some software, you can use an expense instead of vendor bill, and an expense would be used when there is no timing difference between making a purchase and paying for it. So a good example would be credit cards, right? If you go to Home Depot to buy some construction supplies for your organization and you pay the company's credit card, it all happened at the same time. There's no timing difference. So we can use an expense versus record on a vendor bill or vendor invoice. So let's go through examples for source documents for expenses. Let's see. So the first one I have here is a vendor bill from an airline. And it's for a grocery charter. You'll see for a remote First Nation. And you'll see, just like a customer bill, a vendor bill includes all the information that's important for our bookkeeping, such as the invoice number, the date the invoice was issued or purchase made, the details, what it's for, and then the total. It will also include payment terms normally. So let's see if this one does. So this one doesn't have payment terms, and this is because this airline actually won't fly until they receive a payment. So it's always prepaid. Many times you'll see payment terms on vendor bills. So now what it doesn't have is allocation to program or department, right? So when we receive a bill like this and we're trying to enter it in our system, if we're not sure what the allocation is, this is when we want to ask a program manager or maybe refer to a check requisition. Hopefully there is a check requisition with this bill, and then it tells us what the allocation is. So let's look at an example of a check requisition. So it's pretty basic. There is a date, there is who the amount is payable to, payment amount, form of payment, which is EFT in this case, purpose of payment. In this case, somebody is getting reimbursed for using their personal cell phone. There's allocation to an expense account, right, a category, cell phone expense, and then allocation to department or a program band, okay? And so it says who it was initiated by, was requested by this then employee. And then it says who it was approved by. So in this case, there is an email attached from a program manager or a counselor approving the expense. In other cases, you would just have a physical signature in here, and there is a date of approval here. And this form is to make sure that our expenses are, they follow proper process. There is a proper initiation, proper approval, and proper program allocation. Our next example here is a travel claim form. So it's very common because when working with First Nations, we have to travel to and from the First Nations, and maybe sometimes travel for business to different places and cities. And so very similar to a check requisition, it just has all the information of who it's payable to, what the amount is. You'll see in this case, it's broken down to different parts of travel expense, such as meals, accommodation, mileage, and it's based on the approved rates. But the main point here, it has approval by a program manager, and it has allocation to expense category, which is clearly travel, and a department, right, which is band support in this case. So all these things are important for our bookkeeping. Another example for expense supporting documents is an Interac payment notification. So when we make electronic Interac payments, normally we would receive an email with a notification saying the payment was deposited. So this can be used as support for our bookkeeping as well. Okay. So next we're gonna speak about payroll and source documents for payroll. Now, unfortunately, we don't have examples because all payroll information is strictly confidential, so it was difficult to make the examples meaningful when all the names are deleted. So we're just going to talk it through. Payroll can be done in-house using our bookkeeping software, or it can be done through a payroll service such as ADP, Payworks, and there are many others. We're in control of our payroll in both options, whether it's done in-house or through a third party. Using payroll service makes it a bit easier for us just because they're responsible for calculating and remitting employee deductions, such as CPP, employment insurance, and income tax when applicable. And they're also responsible for issuing all tax slips, such as T4s, pay stubs, and records of employment. So using a payroll service sometimes is really efficient because then errors in calculating deductions and in preparing forms aren't very likely, right? Because they're experts in that. So source documents for payroll, if we're doing it in-house, would be employee timesheets for hourly employees. And then if we have salaried employees, they have employment agreements normally kept on file. So we wouldn't necessarily have a supporting document for every pay period, but we would keep their employment agreement or any letters about their raises and current pay rates in their employment files, so they can be referred to if we're ever requested by the auditors or by funders. If we're using a payroll service, we receive payroll reports after every payroll. So those payroll reports would normally include what's called a journal entry, which is basically a transaction we can follow and enter in our accounts and system to record that payroll. Okay. In an in-house payroll, because we're doing it in our software, no separate recording is required. This is where our organization's operations and bookkeeping are combined. To do payroll, we have to use our software, so it gets automatically recorded. If we do payroll through a third party, then we have to record it in our system based on the reports they provide. That's the difference. Okay, so entering transactions in our bookkeeping system. So nowadays, many software have corresponding names for transaction entry, and they made them easy to relate to. So it would say things like vendor bill, expense, payment, customer invoice, bank deposit, and so on. Some older software or more complicated software may not have easy reference names, and transactions would have to be entered through what's called journals or journal entries. So working with such software is more complicated and requires stronger accounting knowledge or just more repetition, right? You can still learn, how to make certain transactions and do them a few times until you feel you're comfortable with it, because they're entered in a similar manner every time. An example for the older, more complicated software is Sage 300. Okay, let's talk about bookkeeping reports. So the whole purpose of our bookkeeping system is organizing that information we're entering to produce reports we can use for submitting to funders or to management or for assessing the operations of our organization. And so there are a few reports that are key reports in our bookkeeping system, and we're going to go through the definitions here and some examples. So first one is called a chart of accounts. It is a list of all of our categories: income, expenses, assets, and liabilities or debt. So every category in our system is called an account. Chart of account is going to list all of them. Next one is general ledger or GL. So whenever you hear GL, it's not a magic word. This is what it's talking about. And this is a list of transactions for the period sorted by category or account, right? So in a GL, we would have, say, if it's our bank account, we would have a heading for our bank account, and then every transaction by date for the period we're looking through is there with all the details. Next one is called a trial balance. And so a trial balance is a list of accounts with total balances on a certain date. So just like a chart of account would just list our accounts, well, in a trial balance would have a list of all the accounts with their total balances on a certain date. I did notice that some organizations use the term trial balance to describe a GL, general ledger sometimes, and that's fine if that's your internal kind of term, that's fine as well. Technically, in accounting theory, a trial balance just has totals for all the accounts, and a general ledger has the details and totals at the bottom of every account. A general ledger can be referred to as detailed trial balance. This is probably where using both terms for the same thing comes from. So just keep in mind, this could be happening in your organization, and somebody is asking for a trial balance, they can actually mean a GL. Okay. Then another report that's really important in our bookkeeping system is a departmental income statement, or sometimes it's referred to as profit and loss by clause, depending on the software. And so this is your income statement by program. So all the revenue and all the expenses by program. So that one is important because when we do our monthly review, when we submit reporting to funders, we really want to make sure that income and expenses are properly allocated to different programs, right? So let's go through some examples here. Okay, so here we go. This is an example of a chart of accounts. So remember, this is just a list of our accounts, right? So in this particular case, we have account numbers, account names, then a type of account, and then a detail type. So there is all sorts of categories we can use for describing our accounts. And so it's a long list in this case. In some organizations that are new or maybe don't have many transactions, could be a shorter list. Let's look at a general ledger here. So you'll see we have a heading. This is our checking bank account in here. And then it lists all the transactions that happened in this organization from January to December this year. Then we have accounts receivable, that's amounts owed from customers. Same thing, all the transactions, every individual transaction. And then you'll see here that every transaction has a reference to a supporting document, right? So we can see that there is a date, there is an invoice, an invoice number, and normally in our accounting software, we can double click on a transaction and get to the supporting document, review the document, okay? If I keep scrolling down, I can get to my income and expenses. And then you'll see there is invoices from vendors here with, again, invoice numbers and dates, amounts, and memos of description. So this is our GL. So GL is really good to review when you're trying to understand what happened in certain program expenses. If something looks too high or too low, you will review the GL just to see what details went into that particular category and review it and decide whether it belongs there and whether it makes sense for the program. Let's go to trial balance. Let me just share the right document here. So there's a hiccup here with the trial balance. Can you see the trial balance now? Okay, good. Okay, so you'll see the trial balance lists all of our accounts and their balances on a certain date. You'll notice they're sorted into two columns. There is debit column and credit column. And this is just a part of our accounting. We'll speak about this in later lessons. But for now, just remember the trial balance shows us a total by category or by account at a certain date. Okay, we're on to the last slide. I know this is a little bit of a drier lesson today. Well, I guess we maintain some of the basic attributes of bookkeeping from our ancestors that used to use pen and or pencil and paper to do bookkeeping. But really, this is all should be pretty straightforward, and hopefully we can all relate to it. So bookkeeping verification procedures, again, at month end or quarter end, and for sure at year end, we want to make sure that everything that was entered into our system is accurate, and also that we've captured all the transactions that happened, that went through our bank account or our credit cards. So we capture them in our bookkeeping system. So we talked about bank and credit card reconciliations. This is where we match individual transactions in our records to bank or credit card statements. We also do a transaction review or GL review. So when we had an example of a GL, we saw that for every account, there is the list of individual transactions and a total. So we would review that, not necessarily in big detail, but just to make sure nothing looks out of place, that everything is posted where it belongs. And if we have a question about a certain transaction, we double click it in our accounting software to see where it comes from, what the details are, or we'll ask a person that submits the report to us for transaction details. Program review or income statement by program. So that departmental income statement is a very important document to review, because then we can see how every program performed, and we can see what the story is. Is there underspending, overspending? Does everything look in order? Does anything needs to be corrected? And like we said, reconciliations and review should be performed monthly to ensure completeness and accuracy of our records. Now I'm gonna share the last example here. It's a departmental income statement. So in this case, this is a departmental income statement for band programs for First Nation. So you'll see that here we have our revenue and our expenses for the period. Okay, and then we have the bottom line, which is income or loss. And it's divided by programs. So there is different programs that this First Nation runs under its bands accounts and records. And we can see details for every program. So we always say financial reports tell a story, right? So when we review something like this, we really want to pay attention to the story, okay? So for example, we can see here how well every program within the department did. So we can see that band support, for instance, was pretty much break even. So they managed it pretty well. There is no big surplus or deficit. But on the other hand, maintenance management had a big loss, $114,000. So this is when we ask for detailed GL, we review this and we say, wait, you have $43,000 in repairs and maintenance and $51,000 in wages. Can I see the detailed GL, right? And then we can go through the GL and ask questions about specific transactions. In this particular case, the story is that this First Nation allocates all their plumbing repairs to this program. You can see that this program doesn't receive much money from its funders, but then the First Nation employs a couple of part-time plumbers here. And then also they have a lot of plumbing issues, so they spend money on repairing those issues. And this is why there is a big deficit here. This is just an example of a departmental income statement and how important it is to review. There is also a possibility when we review this statement in particular, we're going to say, well, you know, those repairs and maintenance, they really don't belong to this band program, they belong to the housing. So maybe some of these expenses need to be reallocated to balance out this program and to allocate them to housing where they really belong. And it's just an example of why it is important to review a departmental income statement. Okay, we're done. Thank you very much for your time. And even though we carried over some of the attributes of bookkeeping, being tedious and a little bit boring, you only need to learn it once, and hopefully it sticks with you, and everything else gets more exciting.